Oh yeah, let's try that out. Let's throw 20 developers on that and go for it. You don't have it. Maybe 75% of all the investments don't work. Despite all of your best due diligence and work and analysis, and in 10 weeks, they're standing in front of Sand Hill Road VCs, whether they want to or not. It's very rugged. Many companies have been formed from this program over the years, hundreds. And they've raised a lot of money. You learn the methodologies for doing that.
Hi everyone, my name is Vasil Dab. This is Raisable Founders Hub, where we help to turn entrepreneurs into raisable founders, founders that are capable to raise capital, attract best talents, and build global companies. And today we have a special guest, very unique opportunity to speak with a distinguished leader and innovator from Silicon Valley, Mike Lyons. Mike has co-founded 12 companies, and one of them, SafeView, is now a global standard in airport security. Mike is a venture capitalist for more than 30 years and is managing partner of New Line Ventures. He is an adjunct professor at Stanford since 1988, and he is the co-developer and founder of Stanford Technology Venture Program. Wow, so rich experience. Thank you very much, Mike, for joining us today.
You're very welcome.
How are you doing?
Well, things are busy.
Busy.
As always.
Yeah.
There's always a new company or a new fund or something, new innovations to go after. And so that's what I spend most of my time doing. And then we teach this material, in various programs, both under professional development and, regular courses at Stanford. So, and that's been very successful for the last few decades. Mm-hmm. And we've had a lot of fun with that.
Yeah. I was privileged to join one of the programs as a mentor alongside with you. And so it was a very interesting experience. And I remember when we had our first conversation, you told me that you are going to be challenging because pitching at Sand Hill Road is challenging. Can you tell us a little bit more? How do you help to prepare entrepreneurs to pitch at Sand Hill Road? And in the same time, why is it so tough to pitch at Sand Hill Road? What is the psychology of that investors?
Sure. And that's something we teach in the programs as well, because, entrepreneurs who are looking to, build tech companies and of course get them financed, get investment into them, have to understand the business model of the investors, what drives them, because it's just not, a bunch of random folks with a lot of money to throw around. It's a much more organized and disciplined business than that. And those folks, have to be able to create returns for their investors. They have to pitch their investors just like the entrepreneur has to pitch the investors. It's the same.
Yeah, I think
the pitch is different, but
more responsibility.
It's the same idea. And so how do you convince investors to give you money is the bottom line, right? That's what it all comes down to. And you have to convince them that you have the wherewithal to and the high probability of creating a good return for their investment. Otherwise, the company can't raise money if they can't make that pitch correctly. And the venture capital folks who are trying to raise money for their funds have the same problem. And until they've developed a substantial track record, then their briefings become easier, because they can just point to their track record and say, are you with us or not? Then it becomes a lot more straightforward. A new company that may or may not have much of a track record with the founders have to convince pretty sophisticated investors, hey, you want to be with us. You want to do this. And so one of the courses that's the oldest in the Stanford Engineering School, in fact, at Stanford, used to be called Tech Venture Formation. Now it's called, Venture Creation for the Real Economy. Kind of read, don't talk to us about apps on iPhones. That's like over. Come on. Do something real, okay? That's substantial and durable. That's going to produce a big business over a long period of time. That course is a 1 quarter highly focused exercise that will take potential entrepreneurs and their team that they form in class or bring it in up from outside, doesn't really matter. And in 10 weeks, they're standing in front of Sand Hill Road VCs, whether they want to or not. It's very rugged because that's not a very good amount of time to start to look really good in front of investors. That's what they have to do. So the workload is very high. And they have a lot of coaches to help them, industry mentors, teaching team, the TAs, everybody have a lot of experience doing this. And we have frequent office hours and presentations they have to do. And they have to get up to playing weight in 10 weeks. Not so easy. And they're exposed to a very hard, what would normally be a very hard to get partner meeting with real investors. There are no rules, no holds barred. This is like get in the ring and fight and see what you got, and it's not, oh, they're just students or, they're just, no. Those aren't the rules. The rules is, come on, let's do this. Many companies have been formed from this program over the years, hundreds, and they've raised a lot of money. That's not a requirement in the program. You're not judged on whether you've raised any money or not, but you learn the methodologies for doing that. And what is it that an investor wants to see? And a lot of that is, as entrepreneurs, what do you need to see? How do you assess an opportunity? Is this make any sense spending a lot of time on this, or is this just a turkey? This is a dog. Okay, so we have an entire framework that we give people to use, answer the right questions to be able to assess these opportunities thoroughly, which is really important because you may, as an entrepreneur, look at dozens of opportunities, most of which turn out to be not so good. We're not going to spend a lot of time on that. I've literally been in situations where we worked for 6 months on a potential business. It initially looked very attractive. It looked so attractive that a major VC on Sand Hill Road gave us a term sheet for it. And they said, here's the money, let's go. And we turned them down. Because after 4 or 5 months of really working it, we discovered a lot of things about the market and the intellectual property and a lot of other things. And we go, you know what? This thing's got a lot of problems. And we're going to have a lot of trouble making this successful. Let's stand down, shake hands with the investors, and move to the next one.
So you didn't take the money?
No.
Yeah.
The reason is because, as a CEO, you're on the board, and I'm imagining this presentation a year later in a board meeting where I have to explain, this isn't really working. And I knew that before we took the money. That's not ethical, in my view.
Yeah.
It's not. And it's, it's certainly attractive and compelling. Oh, my goodness. We've checked a very difficult box. We've raised money. It's hard to do. And you say, ooh, we don't want to turn that down. But when you know that the opportunity is really not workable and has a number of really significant things that will kill it, it's really up to you to disclose that. And just to say, okay, look, we know everybody's excited, but cooler heads will prevail.
Yeah.
And let's rework it and get something that we really think is going to work. Because building a new company is so difficult, probably the hardest thing you'll ever do in your life. You need everything firing on all cylinders. The degree of difficulty is so high, and as you've read, I'm sure, the entrepreneurs go through these massive emotional swings from, oh, super excited and very high to, 6 hours later, you're in the dumps. You're going, oh, this is a disaster.
After a few months without the sleep.
That's right. No
Yes.
sleep. I'm never going to make it,
Yeah.
And then, oh, the next thing happens and wow, this is so exciting. It's in people, some folks are good at handling that and some are not. And so entrepreneurship is not something for everybody. It's very emotionally taxing, and the workload is incredibly high, because the only thing distinguishing you from a more established company is speed.
Yeah.
Okay, speed is everything, which means the workload is crazy.
Yeah.
Okay, it's just the nature of the beast. You don't have a lot of money or resources. You don't have a lot of people. You can't throw, oh yeah, let's try that out. Let's throw 20 developers on that and go for it. You don't have it. So how are you going to do it, right? It's like, that's when you can tell very large companies, that have 10,000 engineers on a very project. You can say things like, that's the best you could do. Okay, it's kind of a joke, but it's
Yeah.
difficult.
Yeah.
It's very, very hard.
Yeah.
Yeah.
And so how many companies have you invested as an angel, as a VC?
I don't know. I lost track. I think dozens.
Approximately.
Yeah, I mean,
Do you remember?
I was with 5 different venture funds, including when I started.
Mm-hmm.
Just the one I started, we probably did 20 deals. I don't know, something like that. We were a Cambridge top 5 percentile. So we had a lot of IPOs and exits, and it was a lot of fun. We had good stuff. I was with another fund, I'll call that Fund 6 maybe, but didn't do very well at all. And yeah, and then a few others that were $1 billion in size sort of things, and we did pretty good. We did some nice big wins. It's a difficult business. It really is. And you have to understand, especially if you're investing at the earliest stages, the statistics don't lie. Maybe 75% of all the investments don't work, despite all of your best due diligence and work and analysis and everything else of really smart people who really know what they're doing. What that says is starting these new enterprises is extremely difficult.
Yeah.
This is not easy
Yeah.
to get it right. Really, and it's because there are all these problems in the markets that you may not understand at the beginning. These exogenous inputs you didn't predict, all the rest of this stuff. There are folks who have stated, oh, look, all they have to do is look at these factors and I can tell whether this thing is going to work or not. Well, I had a friend doing a PhD thesis, and in his thesis, he actually proved that I was right. Namely, you can't predict that. The covariance turned out to be 0.
Yeah.
Yeah, you can't. It makes.
Most of the time you need to negotiate, so the term sheet would not be perfect for you as a founder.
I find negotiation to be fairly rare at early stages, unless the terms are really obnoxious. If it's a vanilla A-round term sheet that you would typically get from Silicon Valley, there isn't much. I mean, to talk about, unless you think the valuation is crazy. Valuation is what everybody calls VC math. How much money do we need to get to the next big milestone where we can raise the valuation of the company? What's that number? We'll come back to that in a minute. Okay, that's how much we're going to raise. Okay, that number. And then the question is, how much of the company does the VC want to own? Okay, and don't want to own too much.
Yeah.
Because then that misaligns interest.
Yeah.
And if you don't own enough, if the thing is successful, the VC gets screwed. Okay, it's as simple as that. And so
you always need to find that balance. And do you work with a strategy, with a business strategy, help them to get a clear idea of how much money to raise?
you mean the strategy is what are we going to do? How are we going to execute? What are the milestones? And what is the OpEx associated with those assumptions?
Okay, so pretty detailed strategy.
Oh, if you don't do that, you have no idea what you're doing.
And do you have any selection criteria who can join the program?
I mean, we're at Stanford. It's mostly grad students, and you got to show you got to have a passion for. I want to learn how to build a business.
Yeah, but anyone can join, so anyone can jump into the program.
Yeah, but it's you can't audit it. You're taking it for real. Okay, it's a 4-unit course. It's a huge amount of work.
And can you share with your current job or? Yep. So it's not like MBA, 2 years, and it's difficult to share what I know from people.
I mean, we have a number of GSB people in the course. It's mostly engineers, but I would say various years it was high as 20% GSB people.
Yeah, so I just try to understand if this, how is this different from the group programs you also provide, or it's individual programs? And for example, there are many tech people here with a technical background that are going to turn into entrepreneurs. And usually they have no business background. And so
Yeah,
would they
a
fit
lot
to
of the
that program?
engineers have not much business background.
Yeah.
Some do, but that's the whole idea of this one course that's in winter quarter is to pour in enough business acumen to be able to prosecute this as a business, because at the end of it, that's what you have to basically do, explain, why does this business make sense? Was this not, gee, look at how cool my technology is? Okay, that doesn't cut it. But you can't assume the technology works. That doesn't work either. In other words, you can't, if I were to allow you to say I have a warp drive engine, okay, I can go faster than light. Well, I could build a really exciting business around that. I mean, my goodness, we're going to sell a lot of that stuff, right? We have no idea how to build it. You can't do that. So that's, you can't just throw a slide up and say somehow by magic this technology works. Now let's talk about the business. No.
How much time have you raised money to your companies?
Raising money for 2 companies right now.
You're raising? What stages are those companies?
In revenue growth stage.
So early stage.
They're ready for significant A rounds at this point. That's where they are, but they're not startups. They've been figuring stuff out and building stuff for several years.
What about your largest check you have raised to some of your companies?
I led the 3rd round in one company. I forgot how big that check was. It was more than 10 million. I don't remember, but not huge. I mean, I have friends who've written, $150 million checks. So
Series C and later stages? It's
Yeah.
pretty late stages.
much later stage, almost private equity kind of deals, right? Where the check sizes can get quite large. But of course the strategy is totally different.
Can I ask you a private question?
Well, yeah, as long as you don't put it on the web.
It's kind of a business private question. So what do you enjoy more right now doing? Building companies, raising money for some of the companies, being into the educational programs and working with other entrepreneurs. What brings you more joy?
I like the mix.
The mix?
If you're just investing, no offense, it's a lot less exciting than actually trying to get a certain company to work. When you're totally focused on the investment side, you don't have the cycles to do that.
You actually make things done and you influence on will this company work or not.
Right.
You build partnerships, so
Yeah.
you're more into the race. What do you think about the idea that the deck is just the representation of your understanding of the market or what you are going to build? So when you build a deck, you actually behind every slide, you go and do your homework, a lot of work. Like, do we understand the market in all the sectors? Do we
Oh yeah.
have the good customer interviews and understand the problem? And each slide is like a large work behind that. Some people think that designing a deck is like hiring a good designer.
No, I mean it's like the analog is a bit like you've got some high technology thing, and the joke used to be that DOD used to spend all their money on airbrush artists, to draw fancy pictures of things that technically didn't work.
Yeah.
Okay, but look good. The picture was awesome, right?
Yeah. It's like, hey, help us to craft a good pitch deck, and then say, okay, you will probably need 2-3 months to do that. They're like, what?
Capable investors won't fall for that anyway.
Yeah.
As we teach folks, you have to understand, important to understand that because of the investor business model, what they have to do, they naturally have extremely high levels of ADD, attention deficit disorder, and you have to get to the point very quickly or the meeting's over. That's why I was yelling at those people in the Stanford program we were working, judging. Okay?
Yeah.
I was trying to get them, look, cut the bullshit and get to the point.
Yeah.
Okay, what are we doing here? Okay, this is one of the things we really try to get the Stanford teams to do.
Hmm.
You don't get that result by telling them how great they are.
Yeah.
They're smart, you're at Stanford, all that good stuff, great, nice. Thank you very much.
Yeah.
Now let's get to it.
Hmm.
Okay, you read all the books and everything else. Now we're going to get in a ring and we're going to fight. We're going to see if you're any good at this. It's a lot like operational training. That's why most of the books in entrepreneurship they're okay. I mean, you can get the idea. There are a few really great ones,
Yeah.
like Scott DePoor's book, something like that, that are really, really worth reading. But a lot of them are cookie cutter sorts of things. You only learn this stuff well by trying to do it.
Hmm. Hmm.
It's the on the job experience kind of thing that is really the way you need to learn it. It's a lot like saying, well, I'm going to learn how to fly an airplane by reading this book. Not, okay, it's not going to work because you're going to be potentially proficient with many definitions and environment, and you'll know a lot about how stuff is put together and how you talk on radio, whatever. Sit in the left seat, see what you got. What do I do? I want to do this, right? They have no operational skills.
You just need to go and try and make mistakes and learn from that mistakes, but it's also important.
But you stand in front of folks who've done this before, and smart investors will help you and coach you. But okay,
I think how not to kill the motivation of entrepreneurs by like too many tough questions, but on the same time, you think, okay, if I can kill your motivation, maybe you should not do that. What do you think?
oh, exactly right. If you requires a tremendous amount of effort prosecuted over a long period of time before anything really substantial gets done. And this is why it's so difficult. One of the reasons is because this is brutally hard. And there are lots of ways you can fail and a few ways you can succeed. It's easy to mess up. That's been my experience because the first company I started, which we ended up taking public eventually, that was a 10-year slog. But I thought it was going to kill me. That was really, really hard. This is, and a lot of people help you along the way, and you don't ever want to forget them. Those people were important.
Yeah.
Frequently, the difference between success and failure was that coaching or that support or whatever it might be And so we keep an open channel to everybody who takes our programs at Stanford. Hey, ping in, call in anytime, you know. Oh, we got this new thing now. We're going to do this. How do I do? You know, like, okay, great. Let's talk about it. You know,
Yeah,
yeah.
it's important.
Yeah, it's just, the coaching is important.
Thank you very much, Mike.
Let me pay these guys.
Thank you.
And no, thank you.